Welcome to the Deep Dive. Today, we are plunging into NVIDIA Corporation. I mean, this is a company that's just exploded into public view, hasn't it? Suddenly central to, well, everything from gaming to AI.
It really has, and it's fascinating how they went from, mainly graphics cards to being this absolute linchpin in the AI revolution, trillions in value kind of appearing around them.
Exactly. How did that happen? How did the Pixel company become the engine behind this massive technological shift?
Well, that's the core question, isn't it? Analyzing NVIDIA right now is less about just one company and more about understanding the whole infrastructure being built for, well, the future of computing, really.
They're right at the center.
Right at a pivotal point, yeah.
Yeah.
Sitting between just immense opportunity and, frankly, some pretty complex challenges.
And for this deep dive, we've got a stack of analysis, financials, market research, you name it. Our mission, for you listening, is to cut through all that noise.
Yeah, pull out the really important stuff, the surprising bits.
So you can understand what's really driving NVIDIA and maybe get a handle on this whole AI era without reading hundreds of pages yourself.
Basically, get the essential insights.
Okay, let's unpack this. Where did it all start? NVIDIA wasn't always about AI, right?
Not at all. They started way back in 1993. PC gaming, graphics chips, that was their world.
And they invented the GPU.
That was their big early breakthrough, yeah. The graphics processing unit back in 1999. For years, that was an NVIDIA in most people's minds.
But then something shifted. They saw something else in those chips.
Exactly. A really crucial insight. They realized the parallel processing power needed for graphics, rendering millions of things at once, could be used for other really complex calculations.
Things beyond just making games look good.
Way beyond. Problems that were just too slow, too difficult for traditional CPUs to handle efficiently. Scientific computing, complex simulations, and eventually AI.
And that's this accelerated computing idea.
That's the heart of it. Taking those really heavy computational jobs like training a huge AI model and offloading them to a specialized chip like the GPU that's built for massive parallel tasks.
Makes sense.
And that capability is what let them pivot. It's why they can now call themselves the engine of AI.
So it's not just GPUs anymore. Their focus is much broader now.
Oh, yeah. They're designing GPUs, of course, but also CPUs like their Grace chip and these things called DPUs, data processing units.
ZPUs, what do they do?
They handle networking, storage tasks, basically freeing up the CPU and GPU to focus on the main computation. But the key thing, the really crucial part, isn't just the hardware.
It's the software, too.
It's the whole ecosystem. The software layer they've built around the hardware is just massive.
Okay, so they're still in gaming, professional visualization, automotive.
They are, but the absolute center of gravity now. It's the data center, driven almost entirely by AI. Their mission statement even says it. NVIDIA pioneered accelerated computing to tackle challenges no one else can solve.
And you mentioned the ecosystem that sources really hammer this point home. The platform-centric approach. It's not just selling chips.
No, it's the whole integrated solution. The hardware GPUs, CUDAs, DPUs, high-speed connections like NVLink, all tightly woven together with that critical software layer.
Like CUDA.
CUDA is the cornerstone.
Yeah.
But also things like NVIDIA AI enterprise software, Omniverse for simulations. It's an end-to-end stack.
Which provides more value, I guess.
Huge value for customers building complex AI systems. And very importantly, it makes it really difficult to switch away from them.
Sticky.
Very sticky. Though switching costs are high, that platform is a huge part of their competitive edge.
And they're based right in Silicon Valley.
Santa Clara, yeah. Gives them access to talent, the whole tech ecosystem. Plus, Jensen Huang, the founder, is still CEO. That's pretty consistent leadership. Ticker's NVDA.
Okay, now here's where it gets, well, frankly, mind-boggling. The size of the market they're playing in, especially with AI taking off.
The numbers in these reports are just, wow. Let's focus on the AI parts first. The data center GPU market, estimated over $87 billion in 2024.
Just for 2024.
Yep. And projected to hit over $228 billion by 2030. That's a compound annual growth rate, CAGR, of nearly 14%.
And I saw the U.S. growth rate was even higher, like 28%.
Yeah, highlights the initial massive demand here. And if you look at broader AI hardware market estimates, the sources vary a bit, but they consistently show CGRs in the 20% to almost 30% range.
So growing into hundreds of billions of dollars over the next few years.
Easily. And even older markets like gaming graphics cards are still projected for decent double-digit growth, surprisingly.
Right, but it's crystal clear from these figures. The data center and AI segments, they're not just growing, they're the main engine.
Absolutely exploding compared to the rest. This is what's driving the future growth.
It really validates that strategic shift they made years ago.
Completely. The scale of the AI infrastructure opportunity is just immense, and NVIDIA, well, they position themselves right in the middle of it.
Okay, but with a market that big, you're going to have competition, right? Who are the main challengers?
Well, the traditional ones mentioned are AMD, Intel, and Qualcomm.
And looking at the comparison table and the source, the difference in size is stark. NVIDIA's market cap is in the trillions. The others are in the low hundreds of billions.
Yeah, and revenue follows suit. NVIDIA's last fiscal year was over $130 billion. That dwarfs the others individually.
That scale must be an advantage in itself. R&D spending, manufacturing cloud.
Definitely. More resources for R&D, locking down foundry capacity, attracting top talent, it all helps.
But the really interesting twist in the competitive story, it's not just those chip guys. It's the hyperscalers, right? Google, Amazon, Microsoft.
This is that co-opetition dynamic. It's complicated. These companies, AWS, Azure, Google Cloud, they are NVIDIA's biggest customers, buying enormous amounts of GPUs.
Okay, so they're buying tons of your chips.
And they're simultaneously developing their own custom AI chips. Google's TPUs, AWS has Trainium, Inferentia, Microsoft is working on theirs too.
Why? To save money. Optimize.
Both, probably. And strategically, long-term, they want to reduce their dependence on any single supplier, including NVIDIA, for critical components. Tailor the silicon exactly to their massive infrastructure needs.
So your biggest customers are also kind of trying to replace you, at least partly. That sounds tense.
It's a very different dynamic than a straight AMD versus NVIDIA battle. It's a strategic challenge for NVIDIA, no doubt about it. A long-term pressure.
All right, so given all of that to traditional rivals, the hyperscaler threat, how does NVIDIA keep its lead? What's the secret sauce? What are the moats the sources point to?
Several key ones. But the one that comes up again and again, the one that seems most powerful, is the CUD software ecosystem.
CUDA, we mentioned it. What makes it such a big deal?
Okay, think of CUD as more than just software. It's like the specialized operating system and the entire development toolkit for programming NVIDIA GPUs for things like AI.
And they started this early.
Years before anyone else was seriously thinking about GPUs for general computing. So almost everyone doing serious AI development researchers, companies, they built their tools, their models, their libraries on CUDA.
And you mentioned the number of developers?
Over 5.9 million now. But it's not just the number. It's the billions of lines of code, the years of optimization, the countless hours already invested in this specific platform.
So if a company wanted to switch to, say, an AMD chip,
they might have to rewrite huge chunks of their core AI software. That's incredibly expensive, time-consuming, and risky. The switching costs are enormous.
it's like vendor lock-in, but on a massive scale.
Exactly. It creates this CUDA flywheel effect they talk about.
Yeah.
Great hardware runs CUDA. Well, more developers use CUDA, more software gets optimized for CUDA. It makes the hardware even more valuable, drives more hardware sales funds, more R&D for hardware and CUDA, and it just keeps spinning.
Wow. That's hard to break into.
Very hard. It's decades of development and community building that competitors are trying to catch up on.
Okay, CUDA is number one. What else?
Their consistent GPU hardware leadership is still key. They generally stay ahead in performance and efficiency. Think Hopper, now Blackwell. They're already talking about Rubin next. That raw power matters.
And that leads to market share.
Estimates vary, but sources put their AI GPU market share somewhere between 70% and a staggering 95%.
Almost a monopoly in that critical segment.
Pretty close. Then there's the full stack platform idea, again, integrating the hardware, the interconnects, the networking, and all the software layers. It's an optimized package deal.
Not just selling parts.
Right. Makes them more of a solutions provider, enabling things like AI factories. And that ties into deep industry integration and partnerships. They work closely with those hyperscalers, but also enterprise customers, system builders, researchers.
Building those relations.
Reinforces the whole platform value. And finally, just being the first mover counts. They invested early in GPU computing and AI, building a strong brand and reputation.
And these moats, they work together, right?
Absolutely. They're interdependent. Better hardware makes CUDA essential. CUDA drives demand for the hardware. The full stack makes partnerships deeper. It's a layered defense.
Okay, so we see the dominance, the strategy, the moats. How does this show up on the bottom line? The financial story must be pretty dramatic, linking back to that AI boom.
Dramatic is an understatement. The numbers from fiscal year 2023 through 2025 are just eye-popping. Revenue went from about $27 billion in FY23
Okay.
to $130.5 billion in FY25.
Whoa. Wait, say that again. $27 billion to over $130 billion in 2 years.
Yep, over 380% growth. Hypergrowth doesn't even quite cover it for a company already this large.
Unbelievable. What about profit net income?
Even more extreme. FY23 was $4.37 billion in net income. FY25, $72.88 billion.
That's more than 16 times. 16x profit growth.
16 times, and that flowed right through to their margins. Net profit margin, it went from 16.2% in FY23.
Which is okay.
To an incredible 55.8% in FY25. More than half of every dollar of revenue became pure profit. That screams pricing power and operational leverage.
Okay, but growing that fast, surely they had to borrow heavily, invest massively. What happened to their debt?
This is one of the most interesting points in the financials. Total assets nearly tripled, sure, from $41 billion to over $111 billion. You see the growth there?
Right.
But total debt, it actually decreased from nearly $11 billion down to $8.46 billion over that same period.
Hold on. They grew revenue by almost 5x, profit by 16x, tripled assets, and paid down debt.
How? Their operational cash flow became a fire hose. They were generating so much cash from operations they could fund this explosive growth, R&D, inventory, everything internally, from profits and retained earnings and still reduce leverage.
And incredibly strong, not relying on debt markets during hypergrowth.
It's a very powerful financial position. Shows immense self-sufficiency.
So this brings up the question, what do the key financial ratios tell us? Things that measure health and efficiency.
Let's look at a few highlighted in the sources. Return on equity, ROE. Measures profit relative to shareholder investment. FY23, it was 17.93%. Respectable.
Okay.
FY25, it jumped to 119.18%.
119% ROE, that's astronomical. Means they're generating almost $1.20 in profit for every single dollar of equity.
Extraordinarily efficient use of capital. Just phenomenal profitability on their equity base. Then, the current ratio of short-term liquidity, can they pay their bills?
Right.
It was already strong at 3.52 in FY23, and it improved further to 4.44 in FY25.
So well above the typical healthy level of 2. Lows of cash and near cash assets.
Ample liquidity, exactly. And finally, debt to equity. How much leverage are they using?
Given they paid down debt, this must have dropped.
Plummeted from 0.496 in FY23, so about 50 cents of debt per dollar of equity, down to just 0.107 in FY25, less than 11 cents of debt per dollar of equity.
Wow, that's a very conservative capital structure now.
Extremely. So the ratios confirm the story. Incredible profitability, driving self-funded growth, significantly reduced financial risk from debt, and rock-solid liquidity, all while scaling at an unprecedented rate.
Okay, the performance is undeniable. How is the market digesting all this? Let's talk valuation. What do the multiples look like as of late May 2025? Based on the sources?
Well, the market definitely sees the performance and the potential. The price to earnings PE ratio is cited around 43.5.
Okay, high, but maybe not insane given the growth.
Depends on your perspective. But look at price to sales, PS, that's around 23.6. And enterprise value to EBITDA is about 34.5.
How does that compare to the competition? AMD, Intel.
The source data shows their averages are much lower. Average PS for competitors closer to 4. Average EBITDA around 19.
So NVIDIA trades at a huge premium on those measures, like 6 times the sales multiple, almost double the EBITDA multiple.
A very substantial premium, yes. The market is clearly factoring in NVIDIA's much higher growth, that dominant AI market share, the power of CUDA, the whole platform story. They're paying up for that leadership.
But what's the catch? What's the critical implication of paying that kind of premium?
This is maybe the most crucial takeaway from the valuation section. That high valuation means the market has already priced in a huge amount of future success. Continued, rapid growth is not just hoped for, it's expected, baked into the price.
Meaning, there's not much room for error.
Exactly. Less margin for error is how the sources put it. The stock price becomes highly sensitive. They have to keep meeting or beating those very high expectations, quarter after quarter.
So if growth slows down even a little bit more than analysts predict,
or if competition makes a bigger dent than expected, or there's an operational hiccup or an external shock,
the valuation multiple could shrink.
Precisely. The stock could face significant pressure even if earnings are still growing nicely in absolute terms. If they just don't grow as fast as the market demands, that premium valuation is vulnerable. It's a high bar they've set.
Right. No company is without challenges. Even with this incredible run, what are the key risks and weaknesses the sources highlight? SWOT analysis stuff.
Yeah, the analysis points to several. Weaknesses first. A big one is dependence on third-party manufacturing, mostly TSMC in Taiwan. That's a concentration risk.
Supply chain vulnerability.
Definitely. Also, high revenue concentration, so much comes from data center AI now, and within that, from just a few massive hyperscaler customers. Plus, their products aren't cheap. Premium pricing could be a weakness if competition heats up.
And the external threats.
That hyperscaler custom silicon development is a major one, customers becoming competitors. Increased competition from AMD, Intel is always there. Geopolitical tensions are huge, US-China export controls, and the whole Taiwan situation, given TSMC's location.
That seems critical.
It is. An economic slowdown hitting AI spending is a risk. And always the possibility of some disruptive new technology emerging.
The sources zeroed in on the top risk from NVIDIA's own reports, too.
They did. Number one was failure to meet evolving industry needs. AI changes so fast, they have to keep innovating, keep investing billions in R&D, and keep winning those crucial design wins for their next-gen products with major customers. Missing a cycle could be devastating.
Ties right into risk number two. Intensifying competition. Both the traditional rivals stepping up their game and that strategic threat from the hyperscalers' own chips.
Exactly. And number three, manufacturing, supply chain, and demand forecasting. Being fabless means relying on TSMC. Geopolitics around Taiwan is a constant shadow. Long lead times, component shortages, and just predicting demand accurately when things are moving this fast, it's incredibly complex.
Getting forecasting wrong means either shortages or costly excess inventory.
Right, and the sources gave a really concrete recent example of these risks colliding the China export controls.
Yes, the H20 chip issue.
Exactly. Their Q1 FY26 report mentioned a $4.5 billion charge they had to take for H20 inventory they couldn't sell due to the restrictions.
$4.5 billion.
Ouch. And they said another $2.5 billion in H20 sales couldn't ship that quarter. Plus, their forecast for Q2 explicitly factored in an estimated $8 billion negative impact from these ongoing China limitations.
Wow, so these aren't just theoretical risks on a slide. They are having a direct multi-billion-dollar impact right now.
It's a stark reminder. Geopolitics and regulation can absolutely constrain growth and override even the best technology strategy.
Okay, so acknowledging those very real risks, what's the forward plan? What's NVIDIA's growth strategy outlined in the sources?
It's broad but interconnected. Core idea is keep pushing accelerated computing. Advance the hardware, definitely, but also deepen that software moat with CUDA and related tools.
And extend their AI leadership.
Across the board. Training, inference, systems, networking, expanding software like NIM, NVIDIA Inference Microservices to make deploying AI easier for more companies.
They're not giving up on graphics either.
No, still extending graphics leadership. Using AI for graphics like DLSS, pushing Omniverse for industrial simulation, cloud gaming with GeForce and NVIDIA.
And cars. Autonomous vehicles.
Advancing the AV platform, their drive platform, chips like Orin and the upcoming Thor, plus simulation tools, and just generally leveraging their massive intellectual property portfolio.
A key theme seemed to be moving beyond just the hyperscalers, enabling AI factories everywhere.
That's the big push now. Broaden the market. Get enterprises, governments, research institutions building AI on their platform, not just the cloud giants. The Blackwell launch, new DGX Super PODs, NVLink Fusion for massive scale-up, global partnerships for national AI clouds, it's all aimed at that broader adoption.
So what are the analysts predicting for the next fiscal year, FY 2026? What's the consensus?
The consensus numbers cited point to revenue around $198.8 billion for FY 2026.
So up from $130.5 billion, still really strong growth, about 52% year over year.
Still huge growth, yeah. And non-GAAP EPS around $4.32, which is roughly 44-45% growth. So yes, it's a moderation from the insane triple-digit growth of FY25, but still incredibly fast for a company this size. And these forecasts already factor in things like the China restrictions. But again, those numbers set a very high benchmark. They reinforce that less margin for error point we discussed with the valuation. The market expects this strong growth to continue.
Let's touch on recent events. What big news from the last 6 months or so has shaped this picture?
GTC 2025 was huge. They launched the Blackwell GPU architecture, announced Blackwell Ultra coming next, more powerful, optimized for reasoning, and they even teased the next-gen platform, Rubin Ultra.
Signaling they're speeding up their roadmap.
Seems like it. An accelerated cadence. They also announced new DGX systems based on Blackwell.
And the earnings reports themselves were major catalysts.
Absolutely. Q4 FY25 confirmed the massive full-year numbers. Then the Q1 FY26 report in late May gave a latest snapshot. $44.1 billion revenue for the quarter, $39.1 billion from data center alone.
And that's where those specific China impact numbers came out again.
Yes, laid out very clearly. The $4.5 billion H20 inventory charge, the $2.5 billion in unshipped H20 sales in Q1, and that Q2 guidance incorporating an estimated $8 billion hit from the restrictions. It shows the real financial weight of these geopolitical issues.
But it wasn't all negative in that report, right? Lots of other activity.
Oh, yeah. They highlighted new global AI supercomputing partnerships, Blackwell becoming available in the cloud, releasing new open AI models like Llama Nematron, confirming the next GeForce RTX 50 series for gamers, news about the next Nintendo Switch using their tech, even progress in robotics with Isaac GR00T shows they're firing on all cylinders despite the headwinds.
Quickly on management and ownership. Jensen Huang's still there, founder CEO since '93.
That long tenure is often seen positively. Consistent vision. And he owns a big chunk, over 12% of the stock. Skin in the game.
Largest institutional holder.
The Vanguard Group, with nearly 9%, pretty typical for a giant public company, reflecting index fund ownership.
And ESG, environmental, social governance.
The sources mention a Sustainalytics low-risk rating. Ranks them well among semiconductor peers, suggesting decent management of those non-financial risks, which matters to some investors.
Okay, let's synthesize. We've covered the incredible rise, the tech, the market, the financials, the moats, the risks, the strategy. How do the sources boil this down into the bull versus bear arguments?
The bull case, fundamentally, is built on NVIDIA's absolute dominance of the AI infrastructure layer. That full-stack platform, led by the hardware performance and cemented by the CUDA software ecosystem, makes them almost indispensable for the AI revolution.
They're selling the picks and shovels in the gold rush.
And the railroads, and the assay office. Yeah. Bulls point to the massive, still expanding market opportunity data centers, enterprise AI, automotive, etc. The financials are spectacular proof of concept hypergrowth, huge margins, self-funding expansion, shrinking debt, add visionary leadership and network effects. And the argument is they're uniquely positioned to capture enormous value.
Makes a strong case. What about the bear perspective?
The bear case focuses intently on the risks and that sky-high valuation. The current multiples already price in near perfection and continued massive growth. Any stumble, any sign of deceleration faster than expected?
It's the stock hard because there's no margin for error.
Exactly. Bears stress the intensifying competition, not just AMD and Intel, but crucially, that strategic threat from hyperscalers building their own silicon. That could erode market share and pricing power over time.
And the geopolitical risks aren't just theoretical.
Far from it. China restrictions are already biting. Taiwan risk is always there. Supply chain reliance on TSMC is a vulnerability. Bears also point to the execution risk of maintaining this breakneck innovation pace and the potential for market saturation or cyclicality down the road, especially with the heavy data center concentration.
So acknowledge the dominance, but argue the risks and valuation are too high.
That's the essence of the bear case presented in the sources. Significant headwinds challenging that growth trajectory and premium valuation.
Well, this has certainly been a deep dive. From gaming roots to AI kingpin, through the markets, the money, the moats, the competition, and the very real risks. Hopefully, for you listening, you now have the key insights, the specific details from these sources to really get a handle on this pivotal company.
It's a complex picture, constantly evolving. Understanding the interplay of the technology, the economics, the competition, and those external pressures is key.
So, based on everything we've dug into the phenomenal growth, that powerful CUDA moat, the competition that includes their biggest customers, the serious geopolitical shadows, and a valuation that demands near perfection. Here's a final thought to chew on. What happens when the seemingly unstoppable force of NVIDIA's innovation meets the potentially immovable object of major customers trying to build their own solutions, combined with governments imposing real multi-billion-dollar restrictions? How does a company this big, this dominant, keep clearing the incredibly high bar the market has set for its growth?
That's the multi-trillion-dollar question, isn't it? A story that will definitely keep commanding attention.
Thank you for joining us for this deep dive.
Always fascinating to explore.